Today's number, $15 billion. That's the estimated economic value that honeybees generate every year. Ed, unrelated topic, the head of HR has called me and told me that I can no longer refer to my assistant as Honey. So now I just call her Jiggles. Is that wrong, Ed? Ed's got his head in his hands. Ed likes to think he's important and above all this. Yeah, Ed. Yeah, Ed. That's right. You're way too sophisticated for my humor. Do you want to hear my story about HR?
I don't have a choice.
No, you don't. Okay, good. Gartner acquires L2, and then on a Friday afternoon, have I told you the story? Friday afternoon, I get a call from the global head. This is like 2 weeks post-closing. From the Gartner head of HR saying, you need to call me right away. This is Lois, Lois whatever, HR, and you need to call me right away. I'm like, okay. I call her back and I get voicemail. I literally call it. And by the way, that's a great weekend to not know why the head of global HR is saying you need to call her right away. And she calls me back at like noon on Monday, and I am pissed off, and I've got all the money I need. I'm like, what the fuck are you thinking, waiting all weekend to call me back? I'm like, how do you think my weekend went? And so I read her the Riot Act, which she was not used to because, she's used to everyone kissing her ass. And I said, what's up? And she said at the all hands, so this is what had happened. We have these all hands meetings every Monday morning. And the first thing we do is introduce the new people. And this new kid said, hi, I'm, Bobby, new employee from Vanderbilt. And everyone introduced themselves. And then at the end, I say, does anyone have any questions? And people have questions about the business. And then Bobby goes, I'm curious, what's the vacation policy? And I said, the vacation policy is new employees don't ask what the vacation policy is. And everyone laughed, and I said, to go talk to so-and-so, I'm sure she'll let you know. And the head of HR said, you can't discourage people from taking vacation. That's illegal. Anyways, that was my run-in with HR, Ed.
I don't think you've ever had an HR department, right?
If we have a head of HR, it's time for me to leave.
When you're the head of the company, there's no HR.
I feel like HR is like the land of common sense in a company that's void of common sense. Treat people with decency. I mean, what HR at a big company, you need a head of people, and these are incredibly strategic, thoughtful people, and the best HR managers are really a key part of a team. But basically, our head of HR is Catherine. So I don't like to deal with any of you. I don't want to hear about your problems. I want to hear about all your millennial, expectant bullshit. So I have Catherine deal with all of it. But I used to, I loved being in the services business, except for the employees and the clients. Other than that, it was just I love business except for the employees and the clients. But people are so fucking messy.
It's so interesting. You really do. You really do not like the messiness.
I'm done with it. Having built companies.
Because you've never been down with it, or because you've dealt with it for too long as a CEO? One
of the things I just love about this business, other than we're killing it, we're relevant and making a shit ton of money, which also helps, is I have outsourced all of the people shit to Catherine. Catherine, every Friday afternoon, I let Catherine call me and vent about what fucking children you all are. And I just let her vent to me. And I'm like, yeah, that's got to be rough. Let me know how it goes. Let me know how it goes. Because I used to be that person on the front line, telling some kid who didn't wear shoes to work why he's not going to get a 40% raise and that he should go to Salesforce tomorrow. And I'm not, giving in to him holding a gun to my head as he tells me, our cloud integration is halfway done, and if he leaves, the firm's not going to work tomorrow. I've literally had those conversations okay, so you're in here threatening me and in the midst of tech mail, we used to call it. Anyways, I'm not big on heads of – I've never had a head of HR. I usually haven't had a CFO. I'm usually all over the numbers. I usually don't. I'm usually the CFO is what I am. I like to stay very close to the numbers.
Less into the people. Yeah. Well, we've got a great...
That went off course.
We've got a great guest, Kevin Gordon, coming on. Let's get into this interview.
Let's do it.
Here's our conversation with Kevin Gordon, Director and Senior Investment Strategist at Charles Schwab. Kevin, thanks for joining us.
Thanks for having me. Good to be here.
So just some background on who you are. You are a director and senior investment strategist at Charles Schwab. You work very closely with Liz Ann Saunders, we've had on this podcast or on the Prof G Conversations podcast. She is the chief investment strategist. You do a lot of work with her. You are seeing a lot of points of light in the markets, and we wanted to bring you on for that reason. We want to get your take on what's happened this year, but also you're a lot younger than most of the guests we have on this show, and we are excited to have younger perspectives on the show. So thank you for joining us. Let's get into this. I think the first thing I would ask you, we've had a bunch of crazy stuff happen in 2025. We've had a new president come in. We've had tariffs and then not tariffs and then tariffs again. We've had a market crash. We've had one of the sharpest rebounds in history. And now we're looking at record highs. Just as you look back on 2025, what have been your biggest takeaways so far?
Yeah, it's been remarkable. And actually, I was thinking back to, I was speaking at a conference in June with Lizanne, and I had made this comment when we were giving the keynote, but I had a friend text me that morning. It was right around when we got to, unchanged year to date for the S&P 500. I had a friend text me and he said, "Hey, I just checked the market this year, and it looks like it's been pretty quiet." And I said, "Man, what a lovely rock this person gets to live under, where they don't have to check it every day and see the turmoil that we went through in April." But it sort of speaks to the fact that there was a ton of turmoil, and it manifested in a really different way this year than it did last year. And I think the 2024 to 25 switch or comparison is really remarkable, because last year, there was barely any scarring at the index level. All of the turmoil was underneath the market surface. So you only got to sort of a traditional correction for the S&P at the index level, but the average member's maximum drawdown was more than 20%. Our view coming into 2025, when we wrote our outlook for this year, was that you were probably going to see that dynamic flipped. Much of it, almost all of it, our thinking at the time was driven, going to be driven by policy, both on the tariff front, but also on the immigration front, which gets, shockingly, still to me, gets less attention than tariffs. I think it's a much bigger part of the longer term growth story for the economy, which we can get into later. But admittedly, we didn't think it would manifest or happen as fast as it did when you got to early April. But that's really our outlook for the remainder of the year as we look even to the back half, and frankly for a good chunk of the next couple of years, if you think about the world that we live in now, which is one that's driven a lot more by policy that's coming out of the White House in particular. And normally Washington is this kind of sleepier, slower moving beast. Don't really have to pay a lot of attention to it. But when you're talking about two huge components of the economy, which is trade and then also labor, they become much stronger drivers of day-to-day activity. So I think that, as we turn to the back half of the year, it's not necessarily that we're, outright skeptical of the rally or skeptical of what the economy has shown so far this year. It's just that when you actually listen to what companies are saying, and we have, a ton of clients that are small business owners up to really large, executives, we represent a pretty good chunk of the, the average retail investor out there. And when you talk to them and see how they're thinking about this, everything tariff related, and how this is playing out, a lot of the adjustments to pricing or a lot of the expected hits to growth are not really expected to come for a while. So even though you were in that really strong turmoil phase from April into a little bit into May, it was never our thinking that you were going to see everything unfold all at once in terms of the overall impact to the economy. So I still think we have a lot to work through. I do think that hopefully the worst is behind us in terms of the depth and the breadth of what was announced in April. I think that's been one of the reasons that the market's been able to rally. But in terms of this index like volatility, both to the upside and the downside, I'm not sure we're past that.
When you look at the record highs that we're seeing in the S&P, that we're seeing in the NASDAQ, I think there are multiple different conclusions that a lot of people are drawing from that. And maybe it's worth just kind of going through them a little bit and figuring out kind of where you stand on that. I mean, on the one hand, we're seeing this tariff turmoil, and it could be that the markets are saying all these headlines are an overreaction. These tariffs aren't really a big deal and it's going to be fine. That could be something. It could be that this is the taco trade. It could be that the markets are saying these tariffs probably aren't going to happen, or if they do happen, they're going to happen in a smaller way than people realize. It could be that the markets are just too optimistic, that they're just being a little bit irrational. It could be that, I mean, one of the things that I slightly struggle with is, the market is a prediction machine. I stand on I'm in the same place as you, which is tariff impacts are going to come. They're just going to come a little bit later than we might expect. But at the same time, you would think that the market is looking at that, pricing all of that in, modeling out the future cash flows, modeling out the tariff costs, and yet we're looking at record highs. So I'm just wondering, with all of that, and all of those potential conclusions, how do you kind of think about that and how do you analyze it? What would be your view on what the market thinks? I know that's an impossible question, but let's try.
Well, I think it's I like that you put the market in quotes because there is a difference when you talk about, the market at the index level versus at the sector or even at the industry level. And I think, we have recommendations that we put out at the sector level across all 11. We don't go as granular as the 25 industries because it's just a little bit too granular. However, I have found myself peeling back the onion a little bit more to that layer lately, because if you actually look at performance, whether it's year to date, whether it's since the April 8th lows, what has lagged the most are those industries that are sort of at the epicenter of the tariff drama. They're, it's food companies and retailers and consumer staples. You broaden that out to consumer discretionary. It's the auto companies, even this earnings season. I mean, look at the two opposite ends of the spectrum where you've got the banks that were out of the gate first, which did quite exceptionally well. And then you have a lot of auto companies that have struggled and mentioned, a lot of the profit hit they've taken from a tariff standpoint. The difference, though, between a lot of those industries, if you look at something like banks or semiconductors, I mean, their weighted average profit margins are upwards of 20 to 30, sometimes 40%. And they're a much larger share of the overall market in market cap terms. If you look at kind of what is traditional old economy stuff like autos or manufacturing, it's a smaller portion of the market. So I actually think a big reason that we've seen such a strong and miraculous rebound in the market is, yes, those kind of heavier weight sectors or industries or companies in some instances have really driven you back to those new all-time highs.
I'm going to pass it to Scott in a second, but just one thought that occurred to me. It appears that the way that you describe it is that there's a sort of bifurcation in the market. Companies and sectors that are getting hurt by the tariffs and the companies and sectors that aren't. And it's been a tale of two sectors, I guess we would call it. I think the way that you could sort of make the distinction here, and what we are increasingly seeing with these tariffs, is that we have made this very arbitrary line that doesn't really make any sense in today's modern economy of physical goods versus digital services. And for whatever reason, we've decided that we're only going to tariff physical goods. And it's kind of a logistical thing. It's easier to sort of track a physical good that is shipped to America, and we're going to tariff those things. But as you describe the differences we've seen in the market, it feels as though those are kinds of the two buckets that we can categorize the market into. If you're in the business of services, as most of the most valuable companies in America are, you're fine because for whatever reason, we've said services are okay. But if you're in the business of making and shipping physical items, things that we can touch and feel, then you're not as fine. And I'm just wondering if you would agree that that is sort of the right distinction to make, and if you think we could characterize what we've seen this year like that.
Yeah, I think generally, not only in this environment has that been the dynamic, but actually post-pandemic, that has kind of been, in this past 5-year cycle, that's sort of been the dynamic where everything manufacturing related has really struggled. We were sort of calling it, and we weren't the only ones to call it or the first ones to call it, but we were thinking about it in terms of rolling recessions hitting the economy, starting around 2022 into 23, where if you were just looking at manufacturing or just looking at survey-based data, all of that was telling you that we were going definitively into a recession. The offset of that was a much stronger services economy, and is really what insulated us from having to go into, a much broader NBER-defined recession. But I think, even today, you're right to point this out, and it's amazing to me still how many, when I hear people talk about trade and especially criticize the trade deficit, it's incredible that the services surplus we have gets really little attention, if any at all. And I do think that if there was one particular pain point that I would sort of point to and emphasize in this entire, trade uncertainty cloud that we've been in. I do worry a little bit more about the potential hit to our, services demand, because if you start to look actually and dissect some of the inflation data, yes, broadly at the headline level, tariffs have not shown up in a meaningful way. However, if you break it down into core goods and core services, take out the impacts of energy, you are starting to see a little bit more heat on the goods side, but that's being sort of the counterforce to that is disinflation on the services side. However, some of the declines we've seen recently in services, like in the lodging and the hotel and the leisure space, have been pretty strong. So if that doesn't turn, that'll sort of give me a little bit of a more negative signal of what's actually happening in the economy, which is goods prices rising for the wrong reason, and then services prices falling also for the wrong reason. So I think that dynamic is incredibly important to watch, because for the many years that we've been expanding and running a goods trade deficit, we've been expanding and running a services surplus in addition to a capital account surplus. That to me is not a bad thing. Our economy has been able to grow quite well. I know this is sort of it can be now a politically hot button issue, but I think if you just look at the data, how much household net worth has climbed, how much our asset markets have done well. Not to say that there haven't been issues, but I think that those two things are not bad when you look at the goods deficit versus a capital account surplus or a services surplus.
I think we could do like a whole podcast on how Americans psychologically view a difference between digital services versus physically manufactured goods. For whatever reason, the difference between those two things has this massive influence on the way we view the economy and the way we think about America, which is fascinating to me. I'm going to shut up now. I'm going to pass it to Scott.
So I've had trouble focusing on this conversation because all I can think about is that if Ed were to have a baby now with his girlfriend, he's seeing someone, Kevin, you should know that, and he were to wait till the kid was the senior investment strategist at Schwab, and then that kid had another kid until Ed's grandkid was 9, he wouldn't be my age. He'd still be younger than me. And that, Kevin, GDP, AI, all this bullshit, that is unacceptable. We can't have that. This is really freaking me out. Anyways, glad you're here. So I'm literally with toddlers right now. It's like playtime.
You got to take us seriously. This is what your TED Talk was all about.
Ask some questions about AI and make sure you don't give them any sugar. Anyway, and keep both of you away from a large body of water. That's my job here right now. So anyway, I have been struck by a catastrophist like myself who saw these economic policies as being highly irrational and thought it would show up in the markets. And then it did start to show up earlier in the year, and the markets have ripped back. And there's a few things happening or not happening here. Either one, the companies that are driving the markets are somewhat immune to these tariffs because they're services companies driven by AI and not subject to these tariffs. Two, guys like me are wrong, and these policies are actually good for, if not the economy, the parts of the economy that drive the Dow, or the market. There's just some consumer dissonance between what is actually going on and what's happening with these stocks, and we're just kind of waiting for the reality to show up. And there might be doors 4, 5, and 6, but this does seem unusual that if you look at the markets and you didn't know what was going on, you wouldn't know what was going on. So what in your view is going on here? Is this a validation of Trump's economic policies? Is this investor dissonance? Or is it the fact that the markets have moved beyond anything beyond the control of the current administration?
I mean, I think that it's, not as a cop-out answer, because I'll expand on it. I think it is a mix of everything, because if you look at, pre-April 2nd, it's not that we were in a zero tariff world. I mean, we knew that higher tariffs were coming. There were already announcements. It started with Canada, Mexico. There were already announcements and implementations, not just at the country level, but also at the sector level. So the market was starting to digest this and price it in. And even absent the DeepSeek-inspired sell-off that started in February for big tech, there were dislocations in the market where you started to see some of that breakdown. So it's really just the April 2nd sort of moment when all of it became, again, to the breadth and the depth point I made earlier, all of that became a lot more real. And I think at the time, too, when you look at the policy of the administration and what they were using as justification for those tariffs, which, by the way, is still under question in terms of the legality of them, which I'll get to in a second. But that, I think, was the oh my gosh moment from the markets saying this is really an effort to sort of turn this ocean liner around with the attempt of doing it like we would with a speedboat. So I think some of it is maybe the market being a little bit more sanguine about what the goal of the administration is, not necessarily being as serious about closing these trade deficits and making sure that we source things here and becoming this export powerhouse, which economically you could argue is just, it's just not feasible, not least because we just don't have the labor force for it. But I think the other thing too, I mean, there are other aspects of this that are still unresolved. Number one, and you guys, have mentioned this a lot in the past week, all of these deals and frameworks that have been sort of put together, they're not binding in any ways. Now, no ink has really been put on paper yet. I think even with some of these investments that are being proposed either from Japan or from the EU, there's a lot of questions around how that's enforced. There's a lot of questions, especially for the EU. I think what struck me the most reading it on Sunday when I got the notification was the commitment from an energy perspective. Because even the way that energy policy is being approached right now, there's this goal of becoming an export powerhouse, again, for energy in particular. But I'm not really sure how you do that when there's also the goal of making sure oil prices stay low, and that doesn't really inspire, energy production in this country. So I'm not sure how you ramp up, close to $800 billion worth of energy exports to the EU. So those are a couple of examples where I think the market's probably being a little bit more optimistic that either those won't be enforced as strongly, or that there will be a question around the legality of the tariffs. I mean, we're going to start hearing, oral arguments this week, later this week, as to whether the IEEPA tariffs, which is what everything so far has sort of been under, minus the sectoral stuff, whether that is legal or not. But I think that, to answer your question in maybe not the most, direct way, I do think it's a combination of many things. At the end of the day, for, large cap U.S. companies, I'll borrow a quote, from one of he's become a good friend of mine, Tom Keene at Bloomberg, but he always says, companies adjust. So what our argument has been most of this time throughout the tariff turmoil has been, if you, set the rate, don't change the rate. And we hear this a ton. I hear this a ton from clients. I'm on the road all the time, talking to clients, many of whom are trying to figure out how to deal with this for their businesses. But they've, many of them have told me in particular that they're just wanting the rate to stay where it's at. Stop moving it around, based on the country, stop moving it around based on the sector, because ultimately companies will be able to adjust. I think it'll be harder for smaller companies because they just don't have the balance sheets or the cash positions or, the flexibility to be able to diversify their sourcing. So if you're going to think about it in market terms, that's why I think the S&P 500 has continued to do so well relative to the Russell 2000. Just as an example.
We'll be right back. If you're enjoying the show so far, hit follow and leave us a review on Prof G Markets.
Support for the show comes from Adobe Express. As many of you know, Prof G Markets recently began airing episodes 5 days a week. That's a high-powered jet, a fire hose, if you will, of my voice into your ears. But more show means more content to promote. So how do we keep up? How do we do it? We're turning to the experts, specifically Adobe Express. Our team will set up pre-approved Prof G Markets brand templates to keep anyone from going off the rails. They have copyright-friendly generative AI, so no legal headaches there. They own their IP, and it will let us collaborate in real time without triggering a Slack meltdown. So keep an eye out for an upcoming video bringing you behind the scenes as we use Adobe Express to whip up a big batch of blinding creative brilliance. And we hope that it convinces you to switch to Adobe Express, the quick and easy app to create on-brand content. Learn more at adobe.com/go/express. This is a paid ad, but it also is true. We love Adobe products and we use them every day.
We're back with Prof G Markets.
Technology is usually deflationary, and you can see how the productivity gains which have been promised from AI, and you can feel some of that just through personal use, that AI should be deflationary. At the same time, we have tariffs. We have an immigration policy that could constrict the supply of labor, which would be inflationary. In Schwab's view, which is the stronger force? Where does Schwab see interest rates and inflation headed the rest of the year?
I think for interest rates, kind of the path of that we've been on, which I've been calling the path to nowhere in terms of, if you look at the 10-year yield, I mean, it's largely been trendless for the past year or year and a half. I mean, it really hasn't moved. It's stayed in a pretty wide range. I think that speaks to the upward and downward pressure that we're facing from a policy, standpoint, in terms of the risks of some inflation from immigration policy or tariffs, but also the back end of that, which I think is more important, which is potentially the growth negative that you have. Not necessarily as much with tariffs. I actually worry a little bit longer term that from the labor policy side, if we continue to go down the route of trying to constrict or, sort of restrict growth, particularly with foreign-born labor, not just via deportations, but sort of at the border, at the physical border or non-physical border of people coming into the country to sort of fuel our labor force growth, that all, over time is a hit to growth. Because, at the most basic level, the product of economic growth is really just whatever you get from productivity growth and your labor force growth. So if we're not assuming some massive boom in productivity, which it's been generally okay over the past several years, but if you're going to hold that sort of where it's been, but you're going to see your labor force growth continue to stall or fall, then you probably have lower potential GDP growth. I think that from a labor policy standpoint, I don't necessarily view it as inflationary right now, because yes, even though you could go into a world where we have more labor shortages, you can raise wages all you want for a job that you're trying to fill. But if someone doesn't want to do that job, or you can't find the labor, you can't recruit the labor, then you're not going to fill the job. And I think companies will maybe start to resort to what has become a little bit of a trend lately, which is just beefing up their existing workforce, whether it's paying them a little bit more or expanding their work week. The Dallas Fed just released a survey on this for the current month, and they had a special question, and they're surveying companies and what they were doing in response to tighter labor policy, and that's one of the things, or two of the things, that they had mentioned doing. So I think ultimately that probably slows growth, and therefore is maybe a little bit more of a depressant on inflation. So the optimistic take of that would be that you don't go necessarily into a stagflationary scenario where inflation is running really hot, but you also have relatively high unemployment.
So what do you think happens to rates?
Oh, rates, I think that ultimately helps put downward pressure on rates over time. But I also think that when you look at, just the term premium and how investors have treated fixed income over the past few years, and just sort of the built-in now geopolitical risk premium, especially for the U.S., I think it is probably safe to say that we're in a higher for longer sort of interest rate world. And, for all that's happened this year, and when you sort of think about how the Fed fits into this, if they're sort of seeing that their inflation target they're still further away from their inflation target than they are their labor target, which is still the case today, and the economy continues to hang in there, even if it's not expanding at a exceptional pace, then that's probably all the more reason for them to stay on hold or adjust policy just a little bit lower. So as long as they keep rates pinned relatively higher compared to where we were several years ago, certainly compared to post-financial crisis, then yeah, I think that still keeps a higher floor for interest rates.
Just in terms of tariff pass-through, we've started to see Q2 earnings are starting to come in, and we are starting to see signs. P&G this week, I think, is a good example. Big consumer-facing American consumer company, and they're saying, yes, we're going to see, $1 billion in tariff-related costs, and we're going to see some compression in our EPS growth, and we're also going to pass on some of the cost to the consumer. It's kind of like exactly what you would expect if you were to read it in an economic textbook. What would happen if you put these tariffs on? Yeah, they're not going to pass everything on to the consumer because the consumer wouldn't buy the product, so they'll probably just share it. I mean, to me, I look at the earnings so far, and I'm like, this is precisely what we all thought would happen. And I'm just wondering if you look at the earnings that we've seen so far this earnings season, and if you draw the same conclusions. Basically, that tariffs have had a somewhat negative impact on shareholders, and also a somewhat negative impact on consumers, and that is a trend we're going to see continue to play out for the rest of the year.
Yeah, I think I would generally agree with that. I think still it's a small share of overall earnings. And when you look at, the aggregate S&P 500 and what earnings growth has done, The blended growth rate, we call it. So taking what's been reported in addition to and combining it with the expected growth rate for the rest of the quarter, that's continued to move up throughout reporting season, following a similar trend, which you normally see during reporting season, but in particular, the past couple where we started very low because analysts lowered the bar so much because they really didn't know, how to bake in a lot of the tariff impacts. But then we ended up at pretty exceptional levels. And just as an example, for Q1, we started at low to mid single digits for expected growth for just that quarter. And by the time we got to the end of the reporting season and the end of the quarter, you were at almost 14% for earnings growth. So there was just this massive jump higher because the bar was set so low. And that's a similar case of what we're seeing so far early days for the second quarter. And I would mention too, it's similar for the third and the fourth quarter. None of the earnings optimism in the first quarter was extrapolated to the rest of the year. So the bar has been set super low, and it's easy, in a relative sense, for companies to jump over that bar, which is why the beat rate has been, close to 80%, which is pretty exceptional. So you're seeing it, happen in certain companies, like you mentioned, but so far it's a bit more, idiosyncratic and company specific, where it's not filtering through to the rest of the economy. Ultimately, this comes down to what we've been talking about a lot in terms of services, whether the demand for services really starts to get hit. And if the weakness in some of these more consumer-facing or cyclically oriented parts of the economy, if that starts to translate into broader consumer weakness and then you get a hit to the labor market, that's where sort of the economy becomes one, where you start to see everything kind of roll back into a recession. But I think that, we need more time with this, because to the earlier point, I made about companies just having not adjusted prices yet, and really not having to probably do it until closer to the end of the year. There's a lot of pricing agreements and contracts that you can't adjust, even if you're starting to face higher tariffs. We've also got an inventory build that we're still working through, as corporate America, that we're still working through. So there's still enough of a cushion, I think. And this, doesn't really start getting real, I think, for the broader economy until the end of the year. But again, you would need to see a much more material hit for those sectors and industries that have really, really strong profit margins, because a lot of those have been the ones that have been carrying, most of the market's gains recently. And it's not just a couple. I mean, there's quite a few. But if it starts to translate into weakness for those sectors, that's where I feel that you probably see a broader hit to the economy.
What do you think is going on with the meme stock craze? We talked about it last week on our podcast. What does that tell you about the markets right now? I mean, this massive surge in retail participation, Open Door and American Eagle, when Sydney Sweeney ends up being on the billboard, and I'm trying to, what else am I forgetting, Scott?
Sydney Sweeney.
Yeah, your thoughts on Sydney Sweeney, Kevin?
That's not a meme stock. That's just common sense. I'll buy whatever she's selling.
Fair enough. That's fundamental.
That's just good business strategy.
But what does this say, and how does Charles Schwab think about this meme stock craze and the fact that it is sort of having its moment once again?
Well, it's interesting that it's happening in the context of, monetary policy that's still relatively tight. Because, so much of the narrative in 2020 and 2021, when you went through that meme craze, was that rates were at zero. There was all of this, double-barreled stimulus going into the economy, both on the monetary and the fiscal side. And that was fueling this sort of rampage into retail trading, which I think is definitely true. But it's interesting that it's happening at a time, again, where interest rates are, the Fed funds rate is above 4%. We're not getting double-barreled stimulus. But I would add that I think the difference, or maybe somewhat of a similarity given the March 2020 experience, but this time we went through a pretty sharp correction this year. But as you mentioned at the beginning of the show, it's been actually the fastest recovery, from a bear market on an intraday basis, because we did hit more than 20% down for the S&P on an intraday basis. It's been the fastest recovery ever. So I think that the buy the dip mentality, especially post-pandemic, has really gripped this market, and particularly for that retail cohort has been a really powerful driver. And for the most part, that's been sort of the dead right call. Think about the drawdowns we've had post 2020. You've had March 2020, where the drawdown, yes, it was sharp, but it was short lived. even in 2022, it was a longer bear market, but in terms of, history, it was not that severe. A 25% drawdown is not bad for a bear market, especially a non-recessionary bear. And the recovery to that, to get back to an all-time high was fairly quick. And then you go to this year when we had a really sharp drawdown again, but it was also short-lived. So the bear market experience for, a post-pandemic investor and for a younger investor in particular, has been very different than what the bear market experience has been like for somebody who's been in this for, more than 10 years.
What asset classes or regions is Schwab most under or overweight?
So in terms of sectors, we've gone neutral, which unsurprisingly we did that after April 2nd, because it was just like with everybody else, we couldn't necessarily game out what was going to be the biggest beneficiary. So we've actually taken even at the sort of regional level, or if you're thinking about U.S. large cap versus U.S. small cap, we've taken more of a factor or a characteristic based approach, which is looking at certain characteristics of companies or industries or sometimes sectors, whether it's strong profit margins or stronger guidance or higher interest coverage ratios, and screening based on that. We've got the tools to do it on the Schwab site. You can do it on other sites, but I know that we have the tools to do it at Schwab. But screening based on that has become a more consistent way to find outperformance over the past few years, because you're not just beholden then to only the tech sector or only communication services, and you're not, shunning energy just as an entire sector. I mean, there are parts of the energy sector, that have done quite well, that have, relatively high interest coverage, that are still sitting on, pretty strong profits after the energy surge that we saw in 2022, for example. It's not the entire sector, but there are components of that sector that have continued to do well. So that's why we've shifted more towards viewing the market in those factor terms, as opposed to just sectors or just large versus small. I do think when it comes to large versus small, it's not a formal view that we have, but it's pretty easy to see how everything tariff related probably is more beneficial up the cap spectrum versus down the cap spectrum. And I think especially as rates stay high, it probably makes sense to stay up in high quality large cap, because almost 40% of the Russell 2000, those companies have no profits on a trailing 12-month basis. So if you combine that with a really high interest cost and probably a tougher input sourcing mix of higher input costs and import costs, that's probably a recipe for more of a struggle for small caps relative to large.
So other than diversification, be diversified, invest for the long term, what, generally speaking, are your big investment themes for 25?
So it's something that dates back to actually the beginning of 24. We were looking at the AI-related craze in terms of, the AI creators and everything chip-related in the semiconductor space in 23, and how much of that, confidence had really sort of exponentially grown from 23 into 24. One of our, bigger themes at the time, and we wrote for our outlook for 24, was actually shifting focus, not at the expense of the creators, but shifting focus to the adopters and how many companies or industries could benefit from a lot of this technology, particularly the ones that have thin margins. And of course, at the time, we didn't know that there were massive tariffs, coming down the pike. But now that you have that as an added pressure point for a lot of companies, those that have, thin margins, or the industries that have thin margins, that's really where we would emphasize sort of thematically, being more exposed or looking for opportunities. And again, sort of speaks to how approaching this from a sector standpoint is a little bit more difficult, because it's not just, it's not just tech that has all parts of tech don't have huge margins. There are parts of it that do have thinner margins, even in consumer discretionary.
So just to press pause, you're recommending sectors that have lower margins because they've been overpunished?
No, not necessarily lower margins because they've been overpunished, but where can they find sort of incremental benefits if they do employ some of these technologies, particularly the ones that have been or have suffered from, higher labor costs over the past few years, because we went through that hiring spree from 21 into 22. They weren't, I don't want to say they were forced into hiring a lot of people, but, you look at how hot the economy was running at the time to meet a lot of the services demand that we had when we reopened. In a way, they were sort of forced to go through that. So now dealing with a lot of that overhang, there's still a lot of great industries out there that are dealing with that overhang. So we're trying to shift focus to what can benefit the most based on, where that lower baseline has been set and where they can improve margins from there.
Stay with us.
Support for the show comes from Public.com. You might already use AI tools to refine your emails and streamline your workflow, so why not see if it can optimize your investing as well? For that, you can check out Public.com. Public.com is the investing platform that takes your money as seriously as you do. With Public, you can build a multi-asset portfolio of stocks, bonds, options, and more. You can also access industry-leading yields, including the 4.1% APY you can earn on your cash with no fees or minimums. But what sets Public apart? AI isn't just a feature, it's woven into the entire experience. From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. And the best part? You can earn up to $10,000 when you transfer your existing portfolio over to Public. Go to public.com/ProfG to fund your account in 5 minutes. That's public.com/ProfG. Paid for by Public Investing. All investing involves the risk of loss, including loss of principal. Brokerage services for U.S.-listed registered securities, options, and bonds in a self-directed account are offered by Public Investing, Inc., member FINRA, and SIPC. Complete disclosures available at public.com/disclosures.
We're back with Prof G Markets. Kevin, I'm going to shift gears and learn more about you. So you are senior investment strategist, you're a director, you've been a frequent guest on TV, you've been on CNBC and Bloomberg TV, and you're 28 years old, which is super impressive. So how did you get here, and what can we learn? What can young people learn? We talk a lot about the issues that young people are facing right now, which are, there are many of them. How did you get here, and what would be your advice to young people who are trying to make it in 2025?
I will say that I've been a bit obsessed with, just the idea of working and doing something that I love for quite a while. So I was a little too obsessed with it, in high school and college, spending a lot of time, networking and making sure I could find the job, that I really liked. I got in touch with Schwab very early on. I want to say I was a freshman in college. And it was one of those instances where I sort of fell in love with the culture of the firm and decided in my head, I said, I'll work there. I just have to figure out how to get there and, what team I'm going to be on. So I sort of did it the reverse, where normally you'd apply for a job and then figure out you like the culture, or if you don't like it. I did it sort of the reverse, where I figured out I liked the culture, and then I sort of found my way to the job. But it was a cool path, because, I got to meet and build out so many cool networks within the company. And eventually, as they invested in me more, we figured out that I really loved research. I loved markets. I grew to love, the stock market over time. Economics was my, formal training in school, so I already had that kind of set. But as those started to come together and I fell in love, more with the macro, time and place was a powerful thing, where I ended up meeting Lizanne at our Impact Conference when I was just starting my senior year. And we kept in touch. And, at the time, I didn't know it, but it was just at the time that she was starting to think about, bringing somebody on. And it just was a serendipitous sort of moment where she called me March of my senior year and said, hey, I'm, thinking of creating this position. And, I see if you're interested. And I said, can I start yesterday? And the rest is sort of history. And it's been an amazing career. My dream job, yes. But I always emphasize to people that it's hard, and I think probably not advisable. A lot of mentors have told me to, go into that right after college. But, I've loved it. Like I said, I've been sort of invested in the career journey for quite a long time. I think one of the reasons that I became obsessed with it is because I've been playing music for, most of my life, since I was 3 years old. I started violin when I was 3. So the obsession of wanting to research something, wanting to memorize a piece, wanting to play with a group, an ensemble, that I think kind of led me to what I do now. And it fits very well with what I do now, my music training.
What do you think Gen Z is missing when it comes to advancing themselves in their careers and building wealth and building security and just frankly getting out there? We look at all of the concerning statistics. I think probably the most illuminating is the fact that a third of us still live with our parents. And these Gen Z adults. What is Gen Z getting wrong, or maybe that might be harsh, but what are the things that you think that this generation could improve on if they want to just make their lives better?
It's a tough question. I mean, I'm really passionate about the subject because I find, that when I do a lot more research into where Gen Z is investing, or, I'll just say younger people in general. It could include younger millennials. But yeah, just stating outright that I don't want to paint it too broad with a brush, but I do think that in terms of building wealth, one thing that I've become, a little bit more, worried about is the way that people treat investing in the market, more as this sort of speculative game and not necessarily as building this long-term wealth. So that to me, there's less of a focus. And when I have conversations with younger people about, 401k stuff or what their companies offer, there's just shockingly little attention to that versus how much can I make on one single stock that might become a meme stock, and the amount of time that is devoted to that, trading, and speculating and gambling. I won't really call it investing because that certainly doesn't fit the definition of how I view it, or how we view it. But I think that in terms of building wealth, there needs to be more of a focus and an emphasis on thinking about the long term, and building that and letting it grow slowly over time. As boring as it sounds, I think that that needs to be emphasized. And I don't want to discount or shy away from what has become this meme craze or how people have treated the market, because I think rightly so. Younger people feel that they've been shut out of sort of these traditional investments, whether in housing is probably the biggest one, where, you look at the median age of somebody who's buying a house now, and it looks like a meme stock. I mean, it's gone up significantly. So there has been this massive restrictive force, on young people trying to get into what is traditionally considered, a really strong wealth building, asset class. So I think that there are reasons for it, but I think that, focusing on the long term, is really important. And in terms of the job market, I would just say that not applying just blindly to jobs, for whatever reason, and again, this is a broad brush, but my own experience is that taking the time to really invest in people and seek out mentors and seek out people who only have your, best interest, at the top of their list, that to me has been what has paid the most dividends for me, not just, professionally, but also personally. It's that who's going to call you, on a Saturday when they know you're not doing well, versus, who's only interested in getting that thing, on their desk first thing in the morning. That I think needs to be thought through a lot.
I feel like there's definitely something in there that is different for our generation. When I look at my position as an example, where I, in a similar position as you, decided, in my case, Scott Galloway was my Charles Schwab, but I was like, this is what I'm going to do, and I'm going to just focus on it, and I'm going to go all in on that. And I wonder if there's something in that maybe there's something about the dynamics of the labor market today where actually young people, you can't just be throwing out LinkedIn applications here and there. It's too competitive, or the gates are too blocked up. And I wonder if there's something about that sort of singular obsessiveness that this generation needs to employ more so than other generations. Scott, any wrap-up questions?
So as you look at, I usually ask this to people who are older than you. In the next 10, you're obviously a very ambitious young man. You've done incredibly well. What does success look like for you in the next 10 years? Where do you hope to be in 10 years?
I mean, I know that it's often seen as a bad thing especially for the younger generation these days, at least what people tell me, that staying at the same firm for a while is a bad thing. But, I grew up with, my mom was at her company for 38 years. My dad was at his for more than 20 years. Lizanne has been at Schwab for 25. She's my greatest mentor here. So I hope that I'm, still here doing the same thing, which every day it changes. But to me, success is still enjoying it and getting up as early as I do. I don't sleep much, not because of the job, because I'm a chronic insomniac, but, I think, being able to still be as excited as I am, whether I'm, getting up at 4 for a media interview or getting up at 3 to catch a flight to California to speak to clients, as long as I still approach it with that same kind of, eagerness every day, to me, that's a win. And being surrounded by, great people, not just at work, but, in life, that to me has been one of the biggest sort of benefits and the reasons that I have stayed, I think, sane, is having, really good people around me and surrounding myself sort of physically with friends, not just through a screen.
Kevin Gordon is a director and senior investment strategist at Charles Schwab. He also serves as a research associate to Schwab's chief investment strategist, Lizanne Saunders. He is a frequent guest on CNBC. Yahoo Finance and Bloomberg TV. He holds a BA from Pepperdine University and an MBA in Finance and Economics from NYU's Stern School of Business.
That's right. And like all the impressive kids did not take my class. You did not take my class, did you, Kevin?
I did not.
Yeah, there we go. There we go. I'm undefeated.
He knows that he can get it for free on YouTube. He's smart.
Pepperdine, the most beautiful campus in America.
I loved it.
Well done. Congratulations on everything, Kevin.
Thanks for joining us.
Thank you, guys. Really appreciate it.
Scott, I don't know what your reactions are, but I'm interested to get your reaction to his career path and what I sort of said about what young people need to do if they want to, quote unquote, make it in a world where it is increasingly difficult to, quote unquote, make it. Any thoughts?
First up, I thought I knew what you were going to say, and you didn't say it. He said he went all in on Liz and Saunders, and you said you went all in on Scott Galloway. So
That's right.
I was going to say that I've learned from that. I've decided I'm going to go all in on Sydney Sweeney. No, seriously though. So where I go with this is the following. I hear from a lot of kids who are applying to college, and the mistake they make is the first piece of advice I give them is like, it's okay to fall in love as long as it's plural. Fall in love with 3, 5, or 7 colleges, because so much of this is a black box. And I remember my stallmate, or one of my stallmates, fellow analyst at Morgan Stanley, had just decided he had to go to the Anderson School of Business at UCLA. And they just decided they didn't want him. He even put off going to school for a year so he could reapply. And then he reapplied and he didn't get in, and he was crushed. And he ended up going to Kellogg, had an amazing career. So what I would suggest is there's nothing wrong with a maniacal focus saying, I really want a job at Schwab, but also recognize a lot of this is outside of your control. And what I don't like is this hustle porn of never give up, because it creates this gestalt where if you don't get the job with Liz Ann Saunders at Schwab, that somehow it was your fault. And if you'd only tried a little bit harder, a lot of this is out of your control. And your dream can be to go to Duke. You can go down there, you can interview, you can get all the right test scores, and you still might not get in because they might decide that they have too many Asian women from Michigan, and you just don't fit into their class. So I like the focus, but also I do think it's a bit of a numbers game. I applied to 9 schools. I got into 2. That's all I needed. 1 out of 7 businesses succeed, so I started 9. And I hate this whole Trump bullshit of never give up. Trump gives up all the fucking time. He just declared bankruptcy over and over and over again. There is a skill to knowing when to move on. So yeah, if you're dead set on working in Schwab, I can see being dead set on working in finance, but don't fall in love with any one company or any one school, because some of this is out of your control. And also, let me move to even darker, more dangerous territory, believing that there's just one person for you. And then inevitably that person breaks up with you and you're just devastated that the one got away. I don't believe there's any such thing as the one. I think there are a lot of people who, for those of you out there who've had your heart broken or feel like no one's ever going to love you again, I think there are a lot of people potentially out there for almost every person. There is no one. Your ability to connect with the right company, your ability to get into the right school is a function of so many things that are outside of your control, so much about the humidity, the weather, a series of uncontrolled moving parts. It's the whole butterfly flapping its wings in the Amazon can result in a hurricane or avoid a hurricane. So be persistent, be focused, but also try and fall in love with 5 schools. Try and fall in love with 50 different institutions in the finance market and realize if you don't get the job at Charles Schwab, you're going to be fine, and try at JP Morgan or just keep trying. And if you don't, if quote unquote the one, I remember just thinking like when a relationship of mine didn't work out, I remember thinking that's it. I'm never going to have love like that again. I'm never going to find someone like that. And that's just not true. It's just not true. So I get it. Be maniacally focused. And then if it doesn't work, move on and become maniacally focused about something else.
There's some in between where it's, as you say, you don't want to put all of your eggs in one basket, but you also want to have some level of strategic focus. You want to say, I'm not just going to spray and pray, whether that comes to applying to jobs or in terms of romantic relationships. I'm going to be strategic about what it is that I want, what it is that I value, what is important to me, what my strengths are. I'm going to think about that. I'm going to go to the drawing board. And then I like what you say there. I'm going to pick like 4 or 5. And I'm going to present to them that I am the one for this job because I've done all of my homework. And then see what happens. And don't be so resentful if it doesn't work out. But I think that is helpful advice. It is certainly somewhere in the medium.
I coach a lot of young men. I talk to young men. You know what advice I occasionally give to people, and it's anathema and verboten? Occasionally I say to someone, give up. And I've been coaching, or I've talked a little bit to this young man, incredibly impressive young man, who at the age of 18 packed up a U-Haul from Tennessee. He was and then was turned down a scholarship. He was a D1 baseball player to move out to LA to pursue his dream of acting. And he's gotten just the wrong amount of success. He occasionally gets a bit part or a speaking role, makes a little bit of money, not, some years enough to get health insurance, some not. And now he's pushing 30. He's engaged. He wants to have kids. And he's making about, on average, the last 9 years, he's averaged $40,000 to $60,000 a year. And his father-in-law, and by the way, along the way, he took classes at Cal State Northridge. He got a degree in accounting. He likes numbers, right? He's good at numbers. I kind of was drawn towards accounting. His father-in-law has a business management firm and has offered him a job at his business management firm. And someday he might take over the business. It is not nearly as cool as being, potentially the lead in the next season of Friends and Neighbors or whatever. And I have said to him, I think you should go be the successor to your father-in-law's business management firm. And there's this dread in his voice that he feels like he's giving up. And I'm like, boss, you're going to become passionate about taking care of your family. You're going to become passionate about doing something really well that you get rewarded for every day, and making good money and being great at something and being able to buy a house. And you're clearly really good with numbers, and passion comes from artistry and mastery. But I do think there's a unhealthy, and I use this word too much, gestalt, telling young people to never give up and pursue their passions, which sometimes they mistake their hobbies for their passions. And that it's okay, go for it. You want to coach an NBA team, go for it, be an assistant coach somewhere for a high school. But at some point, think, okay, the moon's not lining up for me. Maybe I should do something else. I think that's okay. I was going to be an athlete when I was in high school. I was going to be a pediatrician in college. I was going to be an investment banker right out of college. I was going to be in management information systems when I applied to business school. And then I found strategy consulting. And in a million years, I would have never found strategy consulting. And in a million years, I would have never found myself doing a podcast with Ed Elson. Be flexible to opportunities and realize if something isn't working out, great thing about America is you can pivot to something else. You don't want to give up because it's hard work. That's just part of it. So you need a kitchen cabinet of people to advise you. But I hate this notion, mostly fomented by people who consistently give up all the time or declare bankruptcy and move on, that you should never give up. No, there is a time to move on.
Thank you for listening to Prof G Markets from the Vox Media Podcast Network. If you liked what you heard, give us a follow and join us for a fresh take on markets on Monday.